Hi guys, I hope you all are doing well. So welcome to the session. We actually had a discussion in the previous sessions where we went through the different examination questions covering different areas. I had been doing the December 2023 examination paper of this AFM, and we have actually gone through the question number 1 also. That was McKeever. We have gone through question number 2 also. And now what I would actually want to do is that I want to go about discussing question number 3, which is about interest rate hedging. So let's just try to see that what is covered up in this question number 3. Let's just start discussing. It says the following exhibits available on the left-hand side of the screen provide information relevant to the question. So the screen provides information relevant to the questions. It says Abertafol company's interest rate hedging. That's one thing. And then director's queries about the hedging. That's another thing. The information should be used to answer the question requirements within your chosen response options. Now, what exactly are the requirements to the question? Let's try to see, and we'll try to answer. It says advise on the hedging strategies based on the hedging choices that the finance department is considering for the loan of $24 million, assuming the central bank base rate rises to 5.9%. The investment of 18 million, assuming the central bank base rate falls to 4.5%. Support your answer with appropriate calculations and the discussion. It says up to 4 marks are available for discussion. That means out of this 9 marks are going to be available for the computations. That's what it is going to be. So what have I done? I will actually copy this and I will paste it here. It says advise the hedging strategies based on the hedging choices that finance department is considering for the loan of $24 million, assuming central bank base rate rises to 5.9%. The investment of $18 million, assuming central bank phase this rates falls to 4.5%. That's what you have to do. Now, let's just start discussing this question. So what does it say? It is about Abertafol company's interest rate hedging. There are details that are given. There is information that is there. So we're going to make use of this information and the details and take things forward. Okay, so basically what happens is that in this scenario, it says Abertafol is planning to change its arrangement for distributing its products. The company wishes to dispose of its large distribution center in the middle of its home country and invest. What does it want to do? The company wishes to dispose of its large distribution center in the middle of its home country and invest the proceeds of sale in the 2 smaller distribution center, one in north and the other in south. It is currently 1st February 2008. What is the date right now? With respect to any currency or interest rate risk management scenario, the dates are very important. Dates are very important. So it says that it is 1st February 2008. Because of expected timing differences in the 3 transactions, Abertafol company expects to take out short-term loan of $24 million from 1st May to 1st September 2008. So they are expected to take a loan of 28 million. It then expects to make a short-term investment of 18 million from 1st September 8 to 1st February 9. So there is a loan that they are going to be taking, and there is actually an investment that they're going to be making. Now, it says Abertafol company intends to hedge interest rate risk using derivatives. The terms offered on derivatives are based on central bank's base rate. It can be assumed that the futures or option contracts are settled at the end of each month. So now the basis can be assumed to diminish to 0 at the contract maturity at a constant rate based on monthly time intervals. Based on monthly time interval. Um, Now it says $24 million loan. What is the information that is given? Let's try to understand. It says Abertafol can borrow at the central bank base rate plus 40 basis points. So this is what you can borrow at central bank base rate plus 40 basis point. At present, the central bank base rate is 5.1%. Commentators expect government to raise the central bank base rate by 0.8% to 5.9% before 1st May 2008. Abertafol's finance department intends to use forward rate agreements or futures to hedge the loan. It has already found out that using FRA of the loan would result in a net payment of this, which is an effective annual rate of 5.77%. So they already have done the calculations for the FRA. You don't need to go about doing the calculations for the FRA. It says 3-month dollar futures, 500,000 contract size. Prices are quoted at in basis points at 100 minus annual percentage yield. The month is given, the price is given June, September, and then $18 million investment details are given. So I'm actually not going into the investment right now. I'll take things one by one. And the first thing is that I would go about discussing the $24 million loan that we actually have to take. So I would go about discussing the $24 million loan first. Okay, let's see. See what happens is that for the interest, $24 million loan hedging strategy. Interest rate futures, IRF. Number one of them is going to be the steps for the IRF hedge is like this. The different steps for the interest rate futures hedge is like this. Decide the contracts to be used. These should be the contracts with maturity immediately after the borrowing or lending date. The second thing is going to be calculate the number of contracts, adjusting them for the maturity mismatch. Define hedge strategy and open position on the futures exchange. On the borrowing / lending date, close the futures position. So in this case, we were being given the date. It was 1st February 2008. On 1st February 2008, what are you actually going to do? You need to have a short-term loan of $25 million from 1st May to 1st September 8. Construct the hedge. How would you construct the hedge? use June futures as the borrowing will be on 1st of May and the June futures are closest to it. Now, so what do you need to do? You need to use the June futures. You understand why do we need to use the June futures? We need to use the June futures because ultimately we're actually going to be borrowing the money on the 1st of May, and the contract whose maturity immediately comes after the 1st of May is the June contracts. So it's the June contract whose maturity immediately comes after this specific thing, right? So you have to decide that it has to be the June contract. That's number one. Number two things is that you have to establish how many number of contracts should be there. You have to establish how many number of contracts should be there. So number of contracts should be what is the $24 million? What is the contract size? $500,000 is the contract size. Borrowing period is from 1st May 8 to 1st September 8. Borrowing period 1st September, 1st May till 1st September, which is gonna be how many months? May, June, July, August, 4 months, right? Contract period is actually 3 months. So the number of contracts will be how? Will be 24 million divided by 0.5 million multiplied by 4 divided by 3. Multiply by the borrowing period divided by the contract period. So you end up getting 64 contracts. The third thing is that hedge strategy. What is the specific scenario? You are actually a borrower. You're actually a borrower. So always think, what does the borrower expect? No, you don't have to write down. I'm just explaining. You don't have to write down. You could just write down this, like use June futures, number of contracts, things like that. When I talk about the hedge strategy, let me just explain to you how the hedge strategy is going to be. See, 100 minus R is what the futures contract value is. So let's say if the interest rate is 8% and if the interest rate becomes 10%, this 100 minus 8 is 92. This 100 minus 10 is 90. So basically, this is what you expect as a borrower. Basically, what will you do? You would want to sell it here and you would want to buy it here. So the hedge strategy is gonna be what? The hedge strategy is gonna be sell 64 June futures now and buy later. That's what the hedge strategy is gonna be. I just explained it. It's not something needed. I just explained it for the sake of your understanding. Okay, I can show you the number of contract calculation here. $24 million is the loan amount. $500,000 is the contract size. Multiply by the borrowing period of 4 months. Divide by the contract maturity of 3 months. Okay, lovely. Now, so what happens is that hedge strategy is sell 64 June futures now and buy later. Now what would happen is that we would calculate the basis. How do we establish the basis? We say the spot rate and we say the future price. So you must have been given in this scenario somewhere the spot rate, that what is the current interest rate. At present, the central bank base rate is 5.1%. Central bank base rate is 5.1%. So it is like 100 minus 5.1. This is actually gonna give you 100 minus 5.1 is 94.9. The price of the futures contract is given in the scenario, which is 94.55. The difference between these two is going to be considered as basis. Now, remaining basis at 1st May will be how much? See, you have bought the June futures contract. Right now we are standing at 1st of February. So it is simply gonna be period from 1st Feb till 30th June is gonna be 5 months. Period from 1st May till 30th June is 2 months. Is 2 months, right? So the remaining basis is gonna be how? It's gonna be this divided by the total time period multiply by the remaining period. So 0.14 is the remaining basis. Now, so basically what would happen is that the lock-in rate for the interest rate future will be as under. The future price is 94.55. Remaining basis is 0.14. Expected lock-in rate is gonna be this plus this, gives you 94.69%. Hence, Hence, this equates to 100 minus 94.69, 5.31 base rate. So the total cost, including spread, will be 5.31 plus they pay 40 basis point above it. So 5.71%. Five 5.71%, right? Okay. Now, so basically, when we talk about this $24 million loan, for the FRA, it was 5.77%. Here it is 5.71%. So you would say for the $24 million loan, the effective rate using the FRA will be 5.77%, whereas as per the spreadsheet, the rate for interest rate futures is expected to be 5.71%. The interest rate futures should be used for the $24 million loan. Okay, I'll just explaining. Yes, we are calculating the lock-in rate, Jamshed. We cannot, I mean, like for the closeout rate, you need to have the spot rate on the date of borrowing or lending. Now see, what did I do? First of all, every one of you who is having a problem, I'm just explaining things now. Can you just read through these steps for the interest rate futures hedge and let me know if you are okay with this? Can you just read through the steps and can you just let me know you're okay with this? If anyone wants to know anything about the any of these steps, do let me know. Anyone having any question till here? Right? Okay, now I'll move on. Now what did I do? I actually started doing the construction of the hedge here. Now, can you just see this? The steps, if there is any issue, how we reach 5.71? Okay, Jamshed, I'll tell you. Can you just look at these steps which are there in front of you? Okay, now are you all okay till here? Now the remaining basis and all that calculation, can you just look at it? Okay, when you were asking how did we get 5.71, so see, we can borrow at a base rate plus zero point 0.4, base rate plus 40 basis points. So I've added 0.4% to it. Yeah, all okay here? Everyone who had a question, are you all okay here? Okay, lovely. So being able to do this, now we need to move a bit forward and we need to now go about discussing the next one, which is basically, okay, you want to see the remaining basis? Okay, here you go. See, how do we get the remaining basis? It's like the total basis divided by a number of months. Multiply by a number of months remaining. Okay, now. So we move a bit forward now. And now what do we have? We have got the next query. And the next situation is $18 million investment. Now it says Abertafol company can invest at central bank base rate minus 30 basis point. So you can invest at base rate minus 30 basis point. Now what next is there? An election is due on 1st July 8. The main opposition party has promised that it will reduce the central bank base rate uh, and it could be minimum 4.5% if the main opposition party wins the election. At present, election result cannot be predicted with confidence. It can be assumed that the interest rates will not be reduced if the current government wins the election. The finance department has already found out that using a forward rate agreement for investment would guarantee this, which is an effective rate of this. Because of uncertainty, surrounding the election result, the finance department is looking at uh, buying call options as the alternative to using forward rate agreement to hedge the investment. Options on 3-month dollar futures. Uh, the option premiums are in this. This is what it is going to be. Now see, what happens is that what do we need to do now? It's like $18 million investment. What is it gonna be? $18 million investment. $18 million investment is what it is, right? Now what next is there? See, now when I talk about all of this, I would say that for how long do they need to borrow? Do they need to deposit? From 1st September X8 till 1st February X9. From 1st September X8 till 1st February X9. Let's try to understand this. Again, we would create the same approach. This is 1st Feb hedge. Construct the hedge. Relevant. Futures contract will be September, as their maturity is immediately after lending date of 1st September. The number of contracts will be as under. Lending period. How much is the lending period? See here. From 1st September X8 to 1st Feb 9. September, October, November, December, 4 months. January, 5 months. It's like 5 months. Contract period is gonna be 3 months. Hence, what happens is that the number of contracts is gonna be established like this. You would say 18 million divided by half a million multiplied by the period divided by the maturity period. So 60 contracts. 60 contracts. Number 3, what would happen is that you've got 60 contracts, right? right? Number of contract is going to be 60 contracts. Now what do we need to do? We need to actually say by 60 60 call options on the September future contracts, right? The expected net rate using the options will be as under. Interest rate 94.75%. Interest rate is going to be 100 minus 94.75, right? Call premium is going to be the net rate is expected to be this plus this for the base rate. The investment can be made at base rate minus 30 basis points. Hence, net rate will be 4.625%. Hence, net rate will be 4.652%. Right? You get it? So if you are using the option contracts, this is how you would be doing it. Mhm. Okay, how did I get minus 0.298%? Okay, just a minute. Because you see, there is a call premium that is given here. Option premiums are in annual percentages. So it's 0.298%, that's what you get. So even if you get this interest, no, you don't have to calculate the settlement. You cannot do the settlement. Okay, so now what would happen is that you would say 4.94, there was this 5.05% that was achieved. With respect to the $24 million, sorry, $18 million investment that is to be made, the FRA gives a total return of 5.05%, whereas if we hedge using the options on interest rate future, the net return comes out to be 4.947%. 4.947%. Right now, so hence it is advisable that the hence it is advisable that the advisable that the forward rate agreement be used for hedging the expected deposit of the money, right? So that's what you have to do. So that was one of the requirements. uh, Now this is about how you deal with the interest rate hedging, right? This is how you deal with the interest rate hedging. Let's move a bit forward and let's talk about the director's queries about the hedging. Let's try to discuss this. Okay, the requirement is that discuss the queries raised by each of the directors. Now, I'm giving you 5 minutes. Would you give it a try, please? Okay, let's see. It says at the last board meeting, Abertafol Company's finance director explained to the board the possible strategies for hedging the loan and investment. She has received a number of queries from the directors about the loans. Now, what are the queries that the directors have given to you about the loan? Let's just try to see that. It says, Director A stated that the company should not be using derivatives as trading in derivatives was not part of company's operating normal activities. Therefore, shareholders would not expect the company to be using derivatives. So one of the thing is that shareholders not expecting company to be using derivatives. The very simple answer to this is that the company is operating to maximize shareholder wealth, and for this to happen they have to mitigate the risk they are facing. Derivatives help in mitigating risk if used appropriately. The shareholders need not to be informed by every activity that entity is engaging into, as this is the role of Treasury Department to ensure that the risks are appropriately mitigated. So whatever the shareholders would say, we don't care about it, because ultimately shareholders have given you the responsibility to manage. And if they have given you the responsibility to manage, so ultimately you have to manage. You didn't get where am I typing? You didn't get it? You didn't get it? Can you see now? Okay, lovely. Now what's the second point? Can you see the point what I've typed out? Now, let's just move on to the next one. It says, Director B understood that the futures of forward rate agreement might be the best solution if central bank rose up to 5.9 or fell down to this. However, she queried what would happen if rates did not rise as high as this, nor fall as low as this. Abertafol company could possibly lose the chance of benefiting from favorable rates than those offered by futures of forward rate agreements. Now see, what happens is that he is right. The drawback of using the forward rate agreement and the interest rate futures is that these are binding contracts and need to be settled irrespective of the movement in the movement in the interest rates. They mitigate against the adverse movement, but at the same time restrict the benefit of favorable movement. So yes, there is a drawback. Yes, there is a problem. Yes, there is an issue. Right? Okay. Now let's talk about the third thing, the third query that the director had. He stated that options should not be used to hedge 18 million as they would never be the best choice because of their premium. The best choice would not be to hedge at all. Okay. See, what happens is that the director C comments about the options are correct to the extent that a premium cost will be incurred but not appropriate as there may be a situation that entity may be able to take advantage of the adverse movement in case if they use the options and allow the options to lapse when they are out of money. Not hedging at all is exposing entity to excessive risk and is not recommended and is not recommended. Right? Do you get it? Yeah, do you get it now? Yeah, do you get it now? Okay. So what have we been able to do? We have been able to complete this specific queries that were being asked, and this was worth 7 marks. So we've been able to do the question, which was question number 3 of this December 2023 past examination paper. In the previous 3 sessions up till now, we have been able to cover up the whole of the December 2023 exam paper. That included the investment appraisal. It was specifically the international investment appraisal. We've been able to cover up a question on the interest rate risk, and we have now also been able to cover up a question on this performance evaluation. So do you understand this, or are there any further queries that you have with respect to this interest rate risk? Yeah, sure. I can go to the last part of 18 million workings. You could just go there, see. Yeah, what do you want to see? Okay, lovely. So we are done with this question and how we arrived at 4.94. Okay, here you go. Because you could like deposit at 30 basis points less than the base rate. So 30 basis point is 0.3%, right? Okay, lovely. So we are done with this question now. And that actually concludes the December 2023 examination paper.